Hello. In this video, we'll be going through the 5 finance lease criteria. So what is a lease? A lease is a contractual arrangement whereby the lessor gives the right of use of an asset to a lessee. It's kind of like a rental agreement. If you rent an apartment, you are the lessee and the owner is the lessor, and they give you the right to use the apartment. And in return, you as the lessee give the lessor some sort of cash payment on a periodic basis. In accounting, there's a lot of professional judgment that's needed to differentiate between leases that are actual rental agreement, if you will, or if they're essentially more like a sale. So we look at substance over form as followed. This means we look at what is actually happening versus what is legally on the paper. You can have a legal agreement saying it's a lease, but if it's structured more like a sale, then we're going to treat it more like a sale. The legal ownership is irrelevant, and it's based on the economic substance of the transaction. So you have to ask yourself, does this arrangement have the characteristics of what's called a finance lease? And a finance lease is very similar to when you're purchasing an asset versus an operating lease is not. So in some leases, it's going to be really easy to say, yes, this is a finance lease, or no, it's not a finance lease, in which case it's an operating lease. And then other times, you have to look more at just the best evidence available and make a determination. So there's two types of leases. There's a finance lease and an operating lease. And the finance lease is called a finance lease from the lessee's perspective, and from the lessor, it's called a sales type lease. And if you meet one of the 5 criteria, if your lease meets one of these 5 criteria, then it is automatically considered a finance lease. If it does not meet the criteria, then it automatically goes into an operating lease. Number 1 is probably the easiest, in that the purpose of the finance lease is to see if it's more like a sale. So if the agreement specifies that the ownership of the asset transfers to the lessee, that's definitely more like a sale, and it would be considered to be a finance lease. Second criteria is that the arrangement contains what's called a purchase, a bargain purchase option. And that's when at the end of the lease, if the lessor gives the lessee the option to purchase that asset for a bargain price where it's almost certain that the lessee will exercise, then it's considered a finance lease. Let's take an example. If I lease a car, and this is just out there, and my lease agreement says at the end of my 3-year lease, I can buy the car, right, as the lessee for $2,000, whereas usually the fair market value of that car after 3 years is $5,000. Well, in that situation, I'm almost certain to exercise that option at the end of the 3 years, right? Why wouldn't I buy a $2,000 car that's worth 5? And essentially, that's considered more like a sale of that asset, in my example, the car, and it's called a bargain purchase option. So if there's a bargain purchase option, then it's considered to be a finance lease. The third classification, now remember, it only has to meet one of these, not all of these, is if the lease term is considered for, quote, major part of the remaining economic life of the underlying asset. From an accounting perspective, that means if the lease term is equal to 75% or more of the remaining economic life of the asset, then it's considered to be a finance lease. Let's take the example of me leasing a car again. If my lease for the car, my lease terms is 3 years, right? And the car's remaining economic life, so it's not its total economic life, it's just the remaining part at the time that I leased the car. So the remaining economic life of the car is 4 years, because I leased this car new, then I take 3 divided by 4, and it's 75%. So anything higher than 75%, this would be considered that the lease term is for the major part of the remaining economic life. Now, what if the lease term was 3 years, but the remaining economic life of the car is 5 years? Then I take 3 divided by 5, and that equals to 60%. So that does not meet my 75% threshold, and therefore it would not be categorized as a finance lease under option number 3. If it meets option 1, 2, 4, 5, then it could still be considered to be a finance lease. Let's go. Option number 4, or the fourth criteria, is that the present value of the total lease payments equals or exceeds substantially all of the fair value of the underlying assets. So what does this mean? This means, and when we say substantially all, it's 90% or more. So if I'm leasing a piece of equipment that for $200,000 per year for 4 years, and the interest rate we'll use is 5%, and they're paid at the end of each year. I'm going to take those payments and I have to present value them using the present value of an ordinary annuity using n equals 4 and interest equals 5. Now, I happen to know, I've looked this up, and that factor is 3.54595. Now, if you're not familiar with the present value tables, you have to know it for this entire chapter about leases. So please go back and look at previous recordings about present value tables and how to use them properly. I'm going to take the 200,000 times 3.54595, and that gives me $709,190. So that's the present value right here when we're talking about present value of number 4, the present value of the total lease payments, okay? So I've calculated that. If the fair market value, the fair value of my asset that I'm renting, let's say the fair value is $750,000, then I would take this 709,190 divided by 750,000 to get the percentage, and that actually equals to 94.5%. So in this situation, the present value of my lease payments have exceeded the fair value because it's more than 90%, and it would be considered, it would meet this criteria to classify it as a finance lease. If, however, let's just say my fair market value was, the fair value of this asset was $1 million, then I would take 709,000 divided by 1 million, and that equals to 70%. Then I did not meet the criteria number 4. Again, if it meets criteria number 1, 2, or 3, it could still be considered a finance lease. And the last criteria is if the asset that I'm leasing is so specialized in nature that at the end of that lease, the lessor, the owner, has no use for it. They wouldn't use it themselves. They wouldn't be able to lease it out themselves. Then essentially it's like they're selling it to me. So then it would be also considered to be a finance lease. Let's take an example. On January 1, 2027, Sans Serif Publishers leased printing equipment from First Lease Corp. First Lease Corp purchased the equipment from CompuDeck Corporation at a cost of $479,079. The lease agreement specifies 6 annual payments of $100,000 beginning January 1, 2027, the beginning of the lease, and on December 31, 2027 through 2031. The 6-year lease term ending December 31, 2032 is equal to the estimated useful life of the equipment. So basically the lease term equals the useful life. First Lease Corp routinely acquires electronic equipment for lease to other firms, and the interest rate we're going to use in these financing terms is 10%. How should I classify this lease? I have to go through the 5 steps until I meet one of those steps. Steps 1, Does the agreement specify the ownership of the asset transfers? No, it did not. So let's go to step 2. Does it have a bargain purchase option that I'm sure to exercise at the end of the lease? No, it doesn't mention that. Step 3. Is the lease term the major part of the expected economic life of the asset? Yes. The lease term is 6 years and the expected life is 6 years. So as long as it's 75% or more, then we meet this criteria. Step 4 is, so let's just say let's pretend in this that it was actually a 4-year lease term, and therefore we did not meet the 75% threshold, and this would be no. Let's just say. Then we go step number 4. Is the present value of the lease payments equal to or greater than substantially all the fair value? So I'm going to look at my lease payment was $100,000. They give me the present value of an annuity due because the first payment was due on the first day of the lease, and that equals to $479,000. And it tells me back in the problem that the fair value of the asset, right? They just bought it at a cost of $479,000. So if they bought it at that cost, that's the fair value on that day. For purposes of this example, they made it the exact same amount. In real life, that would typically not happen. And the 5th one is the asset of such a specialized nature that it is expected to have no alternative use to the lessor? The answer to that was no. So let's just keep this at that the lease term is actually 6 years. Then in that situation, it meets 2 of the criterias. It's still a finance lease. It doesn't become more of a finance lease. It's just treated as a finance lease. When we record a finance lease, the accounting is very similar to installment notes. If you don't know how to do that accounting, please go watch a video from a previous chapter about installment notes. But on January 1, 2027, Sans Serif Publishers leased printing equipment from First Lease Corp. First Lease Corp purchased the equipment from CompuDeck Corp at a cost of $479,000. The lease agreement, this is all the same. Lease agreement is 6 annual payments of $100,000 beginning January 1. The 6-year lease term ends on 2032, and the estimated useful life is the same as the lease agreement, which means that it's automatically qualifies as a finance lease. And so these 2 bullet points are both the same as what we just went over before. If I had an installment note, I would debit my asset, machinery for the value of the asset, and credit notes payable. It'd be basically what I'm paying for it. Same thing with a finance lease, except the accounts are different. We're going to call it right of use asset, and that's because the lessor is giving me the right to use that asset, but it's still going to be at the present value of the 6 lease payments. And then I have this liability of a lease payable for $479,000.